Good morning and welcome. Patriot Radio News Hour. Joe and Jason here on this Thursday. And, let's just say the Rangers are the World Series champs. The Diamondbacks, well, I think they probably played up to the payroll. Wasn't very dramatic. Kind of got our butts kicked the last two games in a row. But, hey, at least they got there, right? What did Ricky Bobby say, though? If you're not first, you're last. Well, that's kind of what it feels like today if you're a Diamondback fan out there. But don't worry, we got a great show lined up for you. We got to talk about Jay Powell, no rate hike. What did he say? What didn't he say? Atlanta Fed GDP, a massive decline in GDP. So remember, last quarter we had outrageously high GDP. Apparently, the Christmas season may not be, as holiday as they would like. We've got a Treasury 10-year note in utter collapse. You don't see these moves very often. So we got a lot to talk about. Our toll-free number, 800-951-0592. The website at allamericangold.com. And Jason, as expected, Jay Powell, no rate hike. Really, without saying it, came as close as I think you could to saying, man, unless something really bad happens, we're done cutting rates. He did say that they have not even talked about cutting rates. So let's see. We're pretty much done raising rates. We're not talking about cutting rates. And he said that they have no plans as of yet to stop quantitative tightening. That was enough, right? That was enough. The Dow liked that news, right? Because pretty much everybody and their mother's like, yeah, they're probably done raising rates. But then a slew of economic data came out between now and then. Layoffs, Delta, Beyond Meat. We talked about Schwab earlier today, Panera Bread, Pfizer, Vitastat. All of these companies, too, talking about demand drying up. Target CEO, the consumers pulling back. Jeff Gundlach comes out, hey, we're going to be in a recession in the first quarter of 2024. Jason, he actually called a top on bond yields yesterday saying, hey, we got real problems here and things are going to get interesting. It really is. It's a bizarre thing. Yesterday we had a 10-year note near 5%. Today, it's all the way down to 4.65. I mean, we haven't seen 4.65 in at least 2 months, maybe 3 months. It's very interesting what the bond market is saying, and is the slowdown that we've talked about, are the layoffs that we've talked about, are they finally going to show up? All that remains to be seen.
Yeah, Joe, that's all remains to be seen. Now, since the rates looks like they'll just go sideways, we'll have to find out what inflation will actually do next year, because we could be in a state of raising rates is transitory. We're not raising rates. That might be transitory now, right? You got to leave it here for a while, then we got to wait and see. Because if inflation comes on the way it seems like it will in months to come, it does seem like they'll have to reverse this. But if markets start crashing and burning and going crazy, then I guess you roll the dice for what they'll do, right?
Well, yeah, is it wishful thinking that this is going to happen, or do we actually finally have some structural issues inside of the economy, right? Because the only way, listen, I've said it for years now, the only way inflation's going down, millions of people got to lose their job. And I'm not talking about 1 or 2 million. Millions, 10, 20 million people are going to have to lose their job. But yesterday, the Atlanta Federal Reserve, listen, not that anything the Fed does is very accurate, because a lot of things they say they track. Oh, this is an inflation tracker. It's really not, right? It's some kind of made-up mathematical formula that somehow says things are better than what they are or not as bad as what they seem or whatever it may be. But this is probably the most accurate, at least GDP forecast that they have. Yesterday, they cut it in half in one day. They went from almost 2.5% down to 1.2% GDP for the fourth quarter. So I think the bond market's like, well, wait a minute. We were almost at 5% in the third quarter. Now you're saying 1% in the fourth quarter. You can see where a lot of people are like, that's a big change. Things are happening beneath the surface. And then you start looking at, the Target CEO really negative about the consumer. Not only was he like, hey, listen, not only are they not buying extra, but Target, they've got some grocery, but he even said, listen, they're even pulling back on the grocery stuff. They're pulling back across the board. I think this holiday season, it's really going to be a small handful of winners, and I think a lot of losers, right? I think Amazon's going to be a winner, right? Walmart's probably going to be a winner. But, Jason, I think by and large, I think a lot of these retailers are like, yeah, we're probably going to be a loser this holiday season. Patriot Radio News Hour. Joe and Jason will be back on this Thursday. 800-951-0592. A quick look in. We got a relief rally on Wall Street, and this is the crowd that not only is the Fed done, but the economy's going to slow and they're going to stay done. Right now, the Dow's up 300 points. It's been up 400 points, but right now up 300 points. The S&P's up 50. The NASDAQ's up 170. The 10-year note, like I said, 466 right now, but just huge swings in the treasuries. Oil's up 83 cents. Gold's up 5. Silver's up 17. Just really a across the board, I think this is a day where, at least as far as equities, they're hoping that things get better from here. Somehow, right, inflation comes down and the Fed doesn't have to hike anymore, but we don't have a recession. I think that's a lot of hope, right? And that kind of hope usually gets you in trouble. That's why we've been telling you. Listen, I think Wall Street's a dangerous place to be. Check out our friends at YRefi, up to 10.25% returns, not correlated to the stock market. Hey, you got to be in the stock market. You do. You got to have gold and silver in your portfolio and really in your possession. That's a must, right? But if you think you can do it, I don't have to do it. I don't have to be in Wall Street, or I don't have to own gold, or I don't have to do this. You're never going to make it. You're never going to make it, especially now because all of these markets, especially the debt markets, are so manipulated. You are going to get bitten. That's why it's really, I think this next 10 years, diversity is going to be a key. Being diversified. Listen, we were in a trance for 15 years. Hell, they had rates at 0. They took a balance sheet and added $9 trillion to it. Well, not quite, $8 trillion. Right? They added $8 trillion to their balance sheet. They added what? What's the number? $25 trillion to the deficit. Had rates at 0. Yeah, I think equities for that, you know what? Probably was a great place to be. It's not where we live anymore. Make sure you're diversified. YRefi, not correlated to Wall Street, not correlated to the Fed. Doesn't care if Joe Biden's competent or not. Doesn't care who the next president's going to be. Doesn't care about World War III. Check them out. Invest, YRefi.com. That's the word invest, the letter Y, REFY.com, or just make it easy. Just call them. 888-Y-REFI-24. And as you know, got to have a minimum of $50,000. So now, let's go down the road of rate hikes are over, and the economy, we'll see, right? It's definitely going to be slower, maybe a recession, maybe not a recession, and if it is a recession, it won't be that bad, right? So I'll call this the Goldilocks scenario. So yesterday, we had ADP jobs, not very good. Today we had jobless claims, the highest in 2 months. Now it's still low, but it's been, all of a sudden, the last 3 weeks, been creeping up and creeping up and creeping up. Now, 217,000 people filed for unemployment for the first time. I would still say that's a good number. In other words, that doesn't match what I just said. Right? We would expect this number to be, and we'll see where it goes. If it gets to 230 to 250, then maybe, Jason, that fits that, hey, it's slowing, but it's not that bad, but it is moving in the wrong direction. How's that? That I guess that will be good enough. Continuing claims. Now, this one's getting a little stickier again. Up again, and it has been on an upward trajectory for a while. 1.82 million. And this is a number that we want to stay below 2 million. When it gets above 2 million, things start to get bad. So this is another one. It's not at the bad number, but it's getting close, right? So that was tomorrow we'll get the Fed's jobs, well, I guess the government's job number. And Jason, we'll see. Obviously, they don't want to see 300,000 or 400,000 jobs created tomorrow, right? I think that if they get something below 250, and I think they'd probably prefer something below 200,000, because that would kind of fit that little, hey, it's slowing, but it's still not bad.
Yeah, we'll see. I was talking to a few people over the weekend, and there are some big corporations out there that are still hiring, Joe. It's amazing that there's still companies that are still trying to get personnel. And so jobs created, I think, I'm just going to guess it's probably a little higher than what they want, to continue on the path that they say is going to be a better place to be.
Yeah, so tomorrow, if we get 300,000 plus, they'll probably not like that, right? That'll probably be not good. And then this is another one. So we're more than halfway through earnings season. The new big thing that CEOs and CFOs are talking about, weak demand. So before we had inflation, labor cost, lack of labor for a long time. This is definitely a change. And this kind of fits into, okay, see, we're going to slow down. That means the Fed doesn't have to raise anymore. This will mean that inflation will come down. I don't know that means that. But this is, again, we're just trying to live in the psychology of it. They said that the pace of mentions has been holding now for the last several weeks. And according to Bloomberg, it may be the most on record going back to 2000. So that's pretty significant. Right? Because, think about it. We had the housing bubble. Since 2000, we had the dot-com bubble, 9/11, the housing crash, the financial crisis, COVID, and yet Bloomberg is saying that we're on pace to have weak demand from conference calls and filings, earnings season. surpass all of those levels. So, Jason, it's something to be concerned about, right? Because this seems to be widespread. In other words, it's not just automobiles, or it's not just houses. It's not just retail, manufacturers, service, right? They're kind of letting us know, hey, it seems to be kind of everywhere that they're all talking about it.
Yeah. Yes, exactly, Joe. So you got to look at what information's around, but sometimes with the data there comes there's a little bit of fudging. Every time I hear you throw numbers, the government numbers, I always wonder. It's like, did someone stuff that number up or down? How are they leaning? And then now that the Fed is paused and you start to come out with all that information, to me, pausing means that the markets are going to go, Joe. So I think you're going to see a lot more talk and a lot more honesty about how bad things are now, since the rates look to be staying in a sideways position. So we'll just keep pumping it out, right, Joe? You just keep throwing this information out there, because we've been telling people to buy gold and silver, especially over the last year. We're saying this is a sweet spot to be buying it, and there's a reason for that, because pausing rates is not necessarily a good thing. It's a good thing, and it's not a good thing. And why it's not a good thing is because, Joe, the markets and the job losses and all of this stuff, businesses going bust. This is what's getting ready to happen now on a much faster scale, if this is where we're at for a while.
Well, I guess here's what Jason's really saying. Pausing rates is not a good thing if inflation doesn't go away.
Yeah.
So all of this stuff that we just talked about, it better get worse.
Right.
It better get worse.
Right.
Right? Because if it doesn't, right, then all of a sudden we got a different problem. So I've got two, I'll call them legends, and really three. But I'm going to use two for the. Jeff Gundlach has already come out and said we're going into recession Q1 2024. Book it. Okay? But Jeremy Grantham, okay, you guys have know him, Nobel laureate, right? Super smart guy. He came out and said, don't invest in the United States. And was pointing to debt, pointing to interest rates, yields that are going to be much higher for much longer, and basically everything's about getting ready to fall apart. Okay, so you got that side. Then Jamie Dimon came out. Okay, Jamie Dimon, he's on the other side, saying, hey, don't take this pause as we're done here. Don't be surprised if the Fed has to raise it. Listen to what Jamie Dimon said. Not just 25 basis points. Jason, he says he wouldn't be surprised if the Fed has to raise 75 basis points, which would mean where we're at, that would be 3 more meetings of rate hikes. So this is kind of, I think this is why everybody's kind of like, well, which one's going to happen? Right? Are we going to have Goldilocks, where things just slow down, inflation magically goes away, but we don't get, people don't get fired, and we don't have a recession? Are we going the way of Jeff Gundlach and Jeremy Grantham, and right, we got a big problem? Or are we going to go the way of Jamie Dimon, which is, you guys don't get it. They printed so much money, none of this stuff's going away, and rates are going to go even higher. Jason, in all three of these scenarios, I think gold does well. That's why I really like where gold's at. If the Fed is done here, gold's going to do well. Absolutely going to do well. If we go into a recession, gold's going to do well, right? Because now, right, quantitative tightening has to end, right? The Fed's got to at least start talking about rate hikes, if not or rate cuts, if not actually cutting them. And then we saw right here at the end, what did we see here at the end? Rates were going up and gold was going up. So I think that where gold's at is, man, rates go any higher than this, big problem. So we're going to safety. We're going to gold, right? The U.S., they can't support themselves with all of those interest payments. If they get worse, it's going to be even much worse. I think either of these scenarios is, which one's the best one? Probably, I would say recession is probably the best case, right? Gold goes the highest in that case. But longer term, really, I think Jamie Dimon may hold the key to the highest gold price. If you think that the 10-year note in Jamie Dimon's scenario, you're talking 6, 7, 8% on a 10-year note. I think eventually that does cause a collapse, an even bigger collapse, and you probably see the biggest rise in gold. But Jason, those are the three scenarios that are out there, and everybody's trying to guess which one of those is going to happen.
Yeah, we'll talk more about it on the other side of the segment there. So, I think we have markets crashing and burning and job losses, and inflation comes back. And I think the Fed might be good just staying where we're at to see if the inflation worse or the market's worse.
800-951-0592. Joe and Jason, Patriot Radio News Hour on this Thursday. $10 liberties. You're going to save $20 today. $1,095 on $10 liberties. So two $10 liberties, $21.90. So that's well below a $20 gold piece right now at $22.25. So take advantage. Plus you get fractional type material. I mean, a half ounce of gold is still a lot of money, right? I know right now you're talking just under $1,100, but in the future it's going to be $2,000, $3,000, $4,000. I think that the probability is very, very real. 800-951-0592. So like I said yesterday, Jay Powell did what Jay Powell has been doing, stalling. Well, we think there's a lag effect. Right? We're wanting to make sure. So he's justifying not raising rates, even though inflation is way above what they said. Even with their fake numbers, it's double what they say they want it to be. So why would you not raise? I mean, really look at it. I mean, can we be honest? 217,000 jobless claims is nothing. I mean, and that's the worst number in 2 months. Which means, right, it's been less than that. Unemployment rate, and what are we talking about? 3.6, 3.7, 3.8. Right? Historically, I mean, that's darn near full employment. Jason said earlier, hey, people are still hiring. They may not be the job you want, but there's jobs out there. So why aren't they hiking? And this is really, I think, where Jamie Dimon comes in. Jamie Dimon saying, hey, you're kidding yourself. Right? They're going to have to raise more. I don't know. But, Jason, that was what he said yesterday. The reason why we're not hiking is we believe that there's a lag effect, and we want to wait to see if that's actually true or not.
Well, I guess that gives them a little room if things go completely different than what they think. But I think they're going to pause the rates, like you've been saying they're going to pause the rates. Yeah. My guess is the Fed sees the markets getting crushed now. And I'm guessing, let's just say we'll get through the December meeting, and there'll be a pause there. And then by January, we could just see a lot of things going wrong. The job losses will start. The hiring will officially just stop. And I think the Fed believes that a market crash will stop the inflation. You start seeing, people running around the streets, freaked out about the entire economic world. I think they believe that will slow or stop the inflation. But here's the thing. I think they're not too sure of that. And so Jamie Dimon, I think, I think is banking on the fact that early or mid next year, maybe mid next year, the inflation continues as the markets are crashing. And that's where I think, Joe, we get sometime next year where the Feds, they might just say, well, we'll save the markets by printing money and we'll raise the rates to stop the inflation. I kind of think that's where we're going to be at somewhere middle of next year, Joe. I think we'll pause for a while, and then when the crashing and burning doesn't stop the inflation, that's the whole point. If the crashing and burning, if the demand destruction actually cools inflation because people just stop buying, they just can't buy stuff, and so prices naturally go lower because, hey, if you're in a business, you're selling nothing, I got to cut into my margins. That's what I think they're counting on, but we'll see if the inflation really is bigger than what the Fed has set up as a slowing of everything. We'll see.
It is so hard to tell. You know, I'm watching the debt markets, and they are scary. It's just scary how big the deficits are when we'll call it peacetime. It's not really peacetime, and, we're spending, let's face it, let's, add it all up. Ukraine, Israel, right? It's still maybe $100 billion for a whole year. Maybe Ukraine, what they want now may get them over that number, but that's all it is. And we ran a deficit. I know they want to tell you one side. I keep telling you, it was over $2 trillion, and we're way worse. We're only 1 month into fiscal year 2024. It was way worse. And now next week we got to auction another $112 billion. Just because, we don't have the money. And yet we have really an economy that can't get much better than this. That's the hard part. If we can't get much better than this, and we still have these huge debt problems, how bad will it get if a guy like Jeff Gundlach is right? If the economy really slows down, and we may have an example here. This is out of California. California, you say what you want. I know most of us really, nobody's a big fan of California. I love to go visit. Right? I love California. As long as I don't have to live in California, I love it. But they are so important economically. So California, in October, so you got to remember there's two big tax collection months in the year. April, which is the biggest, and then October. Right, because a lot of these businesses, you get a 6-month extension. People that want to hold their money longer pay in October. Well, they were supposed to get $42 billion in tax collection in October. California collected $18 billion. $18 billion out of the 42 that was expected. That's a $24 billion miss. And now they're starting to wonder if California may end up missing or at least paying late some of their bond payments. Or are they going to figure, well, let's just sell more bonds, let's go into more debt so we can make the old debt's payments, right? That's kind of what California's in. It is unclear how this is going to affect the state's bond sale. And now they're saying, is this going to be something that, again, destabilizes debt markets? And if California's having that problem, how many other states are going to have that problem? We'll be back after the break. $800-951-0592, and it appears that California, they're going to have to cut spending. They did have, now think about this, because of all the free COVID money. They had $38 billion in their rainy day fund. Now they're short $24 billion in October alone. But they said that it gets worse and that California will need even more than the $38 billion they had set aside, and that they're in the uncomfortable position of having to pay higher rates because it looks like, Jason, they may have to borrow more money to keep current on money that they've already borrowed, which means, you got to pay more interest. California lost, 350,000 people last year? Right? Their population decreased. And who was it? Who left? It's rich people. You know what? Right? People are like, yeah, I don't want to pay those taxes. Right? California, if you make too much money, you pay over 50% of your income in taxes there. So it is something where I liken it to the government's debt problem, except California doesn't have a printing press. Right? So California is going to be in a very tough spot as far as what they're going to have to pay. And then Jeff Gundlach says, just leaving rates where they're at. Forget about going higher. The amount of debt that gets added over the next 10 years is not sustainable. In other words, we will have a major financial crisis at a federal level if interest rates, if Jay Powell does what he says and leave interest rates, the Fed funds rate, between 5.25% and 5.5%. Because every year, this is the thing I think people don't get, Jason. Every month after month after month, year after year after year, for at least the next 10 years, the amount of interest the federal government pays jumps significantly, even if there isn't any more rate hikes, because all the debt that's maturing was at less than 1%, and now you're paying 5%. It just doesn't work very well.
No, and that's why I think that they're trying to transition the Great Reset, right? We're having a worldwide economic reset, and you can't really start that with 0% interest rates. You can't start a new system at zero. So they're hoping to. I think that the idea is to have a painful, quick recession/depression happens for a few years, and then they transition to whatever this new thing they're pushing. And I think it's multifaceted. Joe, you know me, I don't believe we're that separate. America, the Fed, as the Bank of China, or the Bank of Russia, or any of these other central banks across the world. I think it's all interconnected. I think the BRICS nations and everything that they're doing has something to do with an overall plan. So whatever this is going to look like in the next few years, there's the Agenda 2030. I think is what they're preparing us for, Joe, and there won't be 0% interest rates. I don't see that. So all the debt, that painful, it's it's a really nice way for the Fed to eliminate the competition of smaller banks. I mean, how many banks at the end of this are just going to be gone? In 2008, that big crash, 500 or 700 banks, something like that, disappeared over 3, 4, 5 years. I don't see how we don't lose like 1,500 to 2,000 banks in the next few years, Joe. I just see a consolidation of the guys that actually delve out the money, right? The deposits and the withdrawals are going to be in smaller amount of hands, and banking is going to look a lot different here pretty soon, Joe.
Yeah, it's going to be something where how all of this plays out is going to be very interesting, because like we said, you got a couple of scenarios out there. You got, Goldilocks, Fed is done, economy slows, and inflation goes away, right? Economy slows, but doesn't go into recession. Inflation goes away. That's what Wall Street is. And Wall Street will always be that, right? Because it's got to be, you know the guy that whatever his team is, right? They could be there's not very many, but there's some Cardinal Homer fans, right? That they every year, this is the year, right? The Cardinals they're going to the playoffs, they're going to the Super Bowl. You're like, dude, we're gonna have the worst team in the league. No, it'll be great. Right? Kyler Murray's gonna come off the bench this year, and we're gonna win 9 games in a row. You know those guys. That's Wall Street. That's just what it is. That's who they are. Right? And they've got the propaganda, right? Look at it. If you've got cable TV, direct TV, you know, they got a half a dozen stations that they just cheerlead like it's going to be okay. Right? Look at the dollar. It's not backed by anything. What's it backed? Oh, the full faith and credit. Right. How big of a pounding has the full faith and credit gotten lately? Pretty big, because they made some really bad mistakes. I mean, really bad. Right? Janet Yellen not selling all that long-term debt. What a mistake. Jay Powell not raising rates and talking about inflation was transitory. Massive mistakes. Now the question is Goldilocks going to prevail? Or is it going to be something a whole lot uglier? Either way, having gold in your portfolio, that's going to be a good place to be. Jason and I, we're going to wrap it up right after this. 800-951-0592. Final segment here on this Thursday. $10 Liberty gold pieces, 1866 to 1907. On sale today, saving $20 a coin at $1,095. $1,095 at 800-951. The 0592. And Jason, kind of a weird day, really the last couple of days. Wall Street is obviously excited that they feel that the Fed is done hiking rates. Now the question is this: A, are they really done? Right? Which means everything's slowing down, right? We're not going to get another 4.9% GDP report. The question, I think, now probably shifts into how big of a slowdown are we actually going to get? And I think that remains to be seen. I don't think anybody knows. And the problem is, does the slowdown get rid of inflation? And Jamie Dimon is saying it's not gonna.
Yeah, Joe, we'll see. We'll see what happens. I wonder if you get a combination of both these guys being right, where we got the first guy being right starting now into early next year, and maybe Jamie Dimon's just a little ahead. Maybe Jamie Dimon's just calling it a little too far ahead. Maybe it's third quarter next year when inflation just roars completely out of control, and the Fed's like, well, we have to raise rates now. Yeah, the markets are crashing and burning, and everything's looking horrible, but you can't have markets crashing and burning and people can't afford to buy a loaf of bread, right, Joe? So maybe both right? It's possible. It's just timing.
Yeah, it's all about timing. And again, can we count on? And this is the part that I think this is what makes me nervous. I've got to rely on Jay Powell and Janet Yellen. And let's face it, the clowns in Washington. And what we're seeing is we've got a team that seems to make a lot of errors. A lot of errors. And you got billionaires out there calling for hey, it's time to fire the manager. Right? Hey, the team sucks. We got to make a change. I mean, that's what they're saying, right? Hey, this team sucks. Janet Yellen, Jay Powell, they suck. And this is what has me worried, because I think Matter of fact, I'll bet money on it. Something's going to come up, and they're going to need to react, and they're going to need to get it right. And this is why, you have all these guys talking about we're going to have another financial event because they don't feel like we've got the team, Jason, to get it right.
I don't know what team there is to get it right, though, with Washington, D.C., Joe. You get rid of the cast of characters they have now, you'll just get another cast of characters, a whole new set of ideas to cause problems for the average guy. None of these people are actually helping the average citizen. If you wish for the current team to go away, well, you're going to get what you want. At some point, a new team will be here, and they'll do the same thing they're doing to us now, Joe.
And,
this is why you got to protect
Washington,
yourself.
we know what they're going to do. They're going to spend money. I don't care what team it is. They're going to spend money. It's the other two positions that we've got the bigger problem. 800-951-0592. Listen, if you feel like I do, that way we got the wrong people, call up, get those $10 liberties, $1,095. Jason and I, we're coming back with the half-empty cup.